Jeez.
Terrific. Good afternoon, everybody, or depending where you are, good morning or even good evening. I know there may be some people that are joining this from overseas. Welcome to today's RESI webinar, Navigating Early Stage Investment Term Sheets. Kristen and I are very appreciative of the fact that many of you will have held out through the several reschedulings of this. As I say, the third time's the charm. We had initially done it for, I believe, no, October or November. We then had to reschedule to December, but here we are now in January. Hope everybody had a nice New Year's and is geared up and ready for an exciting 2026. Particularly looking forward to JP Morgan next week in the RESI conference, which we'll be participating in. Kristen and I are today going to give a high-level overview of the different types of early-stage financing term sheets. We will drill down to some extent, but obviously, given the somewhat limited time we have, we won't go line by line. Again, the goal is to give everybody just a high-level sense of what the different types of early-stage financings are in the term sheets that kick them off. I'm the lawyer here, so I'll talk a lot about the technical aspects of the term sheets, but Kristen, as the investor, will talk about the practical aspects, and I fully expect that you'll enjoy her presentation much more than mine. It goes with the territory. So first, let us introduce ourselves. My name is Andy Merkin, and I'm a venture capital and emerging growth companies lawyer in the Boston office of Polsinelli. So we're here in the frozen tundra called Boston right now. Polsinelli, for those who don't know, is a large national firm based in Kansas City. We've got over 1,200 lawyers in 25 offices, very heavy in the Midwest and South, but also have large offices now in Boston, New York, and California. Based in Kansas City, we are actually the outside general counsel for the Chiefs. But as much as I've tried, I've never been able to get a ticket to one of the games. Go figure. More importantly, though, we have a very fast-growing life sciences practice at Polsinelli and one of the largest healthcare transactional and regulatory practices in the country. In addition to being a venture capital and emerging growth companies lawyer, I'm a member of our national life sciences leadership team. So I spend most of my time in the life sciences and healthcare space, working with both early and growth stage companies as well as investors in funding transactions and then in ongoing general corporate matters. I myself will handle the day-to-day general corporate, the organizational, the financing, the venture rounds, et cetera, board matters, data third-party contracts, and then I enlist the help of my much smarter colleagues to work on IP matters, licensing, FDA, cross-border international employment, tax, real estate, and dispute resolution. So we offer the full suite of services to companies as well as investors. And again, my time is spent mostly in the early and growth stage space. And then when those clients ultimately sell or go public, we can handle that as well. I mentioned the RESI conference next week. I'm a frequent moderator of RESI panels. This is my first webinar, as Kristen is aware, so I do ask you to please bear with me. Next week, it's next week already, will be my 32nd RESI conference. Hard to believe. I know, because I do look so young. It is hard to believe I'm 32. It's actually kind of amazing when I think about it. Enough about me, though. Kristen, please introduce yourself to the audience.
Awesome. Hi, everyone. Kristen King Jankowicz. It's a pleasure to be here. Andy, you are so humble. I love this tag team of the investor and the lawyer in the room because both are really key to your success. So dig into this session, ask a lot of questions. We're here to help you. I'm with Boston Harbor Angels, head of group management. I've been an angel investor with this membership group for the last 8 years. Boston Harbor Angels has been around over 20 years, so I'm learning from the folks there. It's a privilege to do all of this. And my career, I've probably had 30 years in biotech, from R&D, commercial, and the last 15 in M&A and in biz dev. So again, board governance, corporate matters, these documents are very legal. I'll say legal beagle. So we're going to try to give you both sides of this and move forward with the presentation because it's really key, especially in the early stage, to understand this and to get both perspectives. And with that, let's just jump in. Andy, do you need me
Great.
to
And
pull up?
I am already having some issues with,
Okay.
just give me a minute here to figure out how to get myself back on the screen. And hold on, we'll get there. Um,
Okay.
no, I don't know
I'm
what
happy
are
to pull up the slides and
Yeah,
let's
Kristen,
just navigate
what are
through
you
it.
what are you seeing right now, Kristen? Sorry, everybody.
Our
Um,
two heads, but
okay.
let's try if I share the screen and
Yeah,
maybe
can you
you
do the
just want
share
to
screen?
tell
And
me. Can folks see
because
that?
I am not seeing us. Hold on, let
How's
me.
that? So now I see the screen, the two of us. And
Uh,
if you'd like to go, the agenda slide is up.
sure, sure. I'm not seeing us, but that's okay. So um, I will figure that out. So as we said, navigating early stage investment term sheets. Um, okay, our agenda today. We're going to talk a little bit about convertible instruments, typically used in seed stage financing. So those are both convertible notes and safes. We will talk a little bit about what is Series Seed preferred stock. We will then give an overview of the NVCA Series A preferred term sheet. Again, fairly high level offering terms, the key things in the charter, key things in the purchase agreement, and then the other ancillary agreements that go along with that.
Okay.
Uh,
Keep
so
going on the agenda or you want to jump in?
no, I think we'll jump in. Can people see? Oh, sorry, I need to do my shares. Can you go to the convertible instruments?
Sure. Convertible instruments is up.
Okay. Okay, so as I mentioned, there's sort of generally speaking two flavors of convertible instruments. Convertible notes and safes. For those who have been doing this, certainly as long as I have, convertible notes have typically been the more traditional approach to pre-equity financings. Safes have come around in the last 5 to 6 years. We'll talk a little bit about both. We'll talk about the advantages and disadvantages of both. So first, just again at a high level, convertible notes. Convertible notes are debt. They do carry an interest rate. They have a maturity date. And as I mentioned, they are debt. So they're on top of the liquidation stack in a liquidity event or a wind down. So what does this really mean? This means that your company is borrowing money from the investor. One of the key things here, as we compare them with safes, as I mentioned below, is the fact that they are debt. So in the case of a liquidity event or a wind down, the notes always get paid back first before any of the equity investors do. That's a default legal provision that's been around for years. Let's talk a little bit about safes now for a minute. So safes stand for Simple Agreement for Future Equity. And to the best of my recollection, and Kristen certainly jump in, they've been around for maybe 5 to 7 years now. Y Combinator in California is the sort of incubator slash accelerator that came up with the safe, or at least institutionalized the safe. It is not a debt instrument. It is as the name implies, an agreement for future equity. There's no interest that goes along with a safe, so you're not paying, 5, 10, 15% yearly interest as you would with a note. There is no maturity date, so they typically will, be out there for as long as, unless and until they, convert or terminate on their own terms. And as I mentioned, they do have very standard language based on the Y Combinator form. One of the particular advantages to safes over notes from the company's perspective is the fact that, again, it is not debt, right? So other, in the case of a wind down or a liquidity event in which the safes do not necessarily convert, it's all of the equity holders of the company, including presumably the founders, are going to participate pro rata. So it's not that the investors who funded the safes get paid back first as they would with notes. One of the really nice things about safes is that they are very simple. The Y Combinator form, which is typically utilized in the industry, is a true form. It actually says on it itself, no changes are being made to this, and everybody is representing that no changes are being made to it, other than obviously tailoring it for the name of the company and the investor, dollars, etc., as well as a couple of very sort of detailed terms, but for the most part, it does not get changed. I will admit that the first time I saw a safe a number of years ago, I was not aware of this, and I went through and marked up that safe on behalf of my client, sent it back to the
When can I go?
investor,
When can I go, Andy?
sent it back to the investor, and I can promise you that did not go well.
Yeah.
As with everything, we learned from experience. So the safe is really intended for, and one of the reasons it's very helpful to have for early stage companies. Very few changes go into it. It's a form as much as possible. It makes the process quick, easy, and not costly for both the companies and the investors. Um, the
I
one
share.
key, I'm sorry.
Keep going.
Yeah,
I'll
so I
chat
said,
before this is
yeah,
over.
I am going to ask Kristen just for her sort of opinion on from an investor standpoint on safes versus notes, what she likes or doesn't like. But the one other key factor here to address is sort of when and why are either notes or safes used. They're typically used at the very early stage because no valuation of the company is set when you are issuing either a note or a safe. So for R&D stage, obviously pre-revenue, pre-commercialization stage companies, which is I'm guessing most of the companies that are represented by the participants here, you do not have to set a valuation, which is a good thing for everybody. It's a good thing again because there's no time and cost involved in trying to set an outside value, get a valuation, be it internal or external. You literally kick the can down the road, but it's seen as a positive. The first price round will come sometime later. The investors in that price round will set or at least help set the pricing of the company at that point when it's a little bit more mature. But for now, you just don't have to worry about that whole valuation discussion and decide and figure out, gee, how much of the company are we giving away? Is this valuation supportable? It's not always an easy task to do, and you don't have to worry about that with convertible instruments, again, because you don't set the valuation. You worry about that at a later time. Kristen, love to hear your thoughts on notes and safes from the investor standpoint, and also to the
Sure.
extent, from your portfolio company standpoint.
Sure. Great overview
Yeah.
and awesome questions that are in there, and I'd love to address them all because those are top of minds. And Andy, you did a really good lead in. So pre-COVID, to your point, we probably saw more convertible notes and not as many safes and more priced early stage rounds. In today's environment, we see a mix of all of it. And from the investor point, there's another thing, and on top of convertible notes, there's a cap in a convertible note. I just look back, I have a mix of both. We're flexible, we're angels. We want to work with the company. The two issues with safes from the angel point is really that there's no, like you said, there's no reason, there's no push saying you've got to convert. There's no protection for the investor. The interest is nice, but and there's no cap. It's really not a money thing as much as right time, early stage, your comment on whether it's a price round or not. We see convertible notes in that early stage and also moving forward in bridge rounds. Sometimes there's a convertible note there. In my portfolio, my shortest convertible note is 12 pages, 62 with all the signatures. This is the real deal, right? And I would encourage everyone that's on the call to really, I know you may not love finance,
Oh.
but it's not rocket science. So just understand a little bit. This is your money. So are you ready to give away equity? And when do you think that next seed round is, or the A, or a convertible note from an A to a B? I have some in our portfolio, mine and BHA's, that have both a safe and a convertible note and in between bridges. So there's a lot of tools that you should absolutely work with a lawyer to
Hmm.
understand, because the devil is in all the write-up details of those documents. And each different tool, if you have a safe, is that someone asked, is that, investor friendly? We love the convertible notes, but we'll work with companies that have a lead investor that already have a safe, that know what they're doing, that it's in the area of interest, and there's a reason. As long as you have a reason to use one of these tools over the other, just really know the language, what it means for you, how it protects you, how it protects the company. And then the debt part of the convertible note is nobody wants to go liquidation in your first couple of years, but you always have to plan. You always have to plan and just be smart about your company, your IP, and where this is going. So to answer a couple of these questions, yes, we prefer convertible
You
notes.
seeing the question? Yeah, I was gonna say you seeing the
Yep,
questions.
yep.
Chris is gonna flag.
I absolutely
Right.
did.
Okay.
The slides available. I don't know, Andy. Well, we can ask. I'm pretty sure they
Sure.
do that,
Yep.
and we'll definitely get these out. This is for you. And again, if you're on the West Coast, some of the safes are there. It's really, what's your financial story? When are you going to convert these? Both of them, it's a role of these is to convert into the next level, to when you have a better comfort for your valuation and for your financing and your inflection points. And the convertible note with the cap is a little bit more telling on what you think you're going to do in the Series A or your fourth seed, et cetera. So I think that's most of
Yeah,
the
so
info.
let's actually, I'm just so looking at some of the questions, and I think we can probably collapse some of these questions into, into one or two responses. So Chris, it said there's a couple questions here about, discounts, sort of what is the
Oh, I missed
what is
that one.
acceptable
Yes.
discount. But why don't we take a quarter step back? Because Kristen has talked about the cap, talked about the discount, but why don't we just do sort of a quick explanation of what those are? And so okay, as we have in here on the third bullet from the bottom, notes and safes, discount versus valuation cap versus most favored nation. So let me just sort of quickly explain the differences. We can talk about sort of what and maybe Kristen can help us understand what market is. So basically, so a discount, and this applies to both notes and safes. The notes and safes provide that, when there is an equity financing, they will convert. And typically there's a minimum, if there's an equity financing for, X dollars or more, it will convert. You don't always see that. I've seen them without any minimum. But let's say hypothetically it says, okay, when there's an equity financing of $5 million, just to throw a number out there, the note or the safe will convert. The conversion discount says and this is favors the investor, when they do convert at whatever valuation is determined and is set in that $5 million price round, whatever it may be, the note or the safe will convert at a discount. So, for example, you often see, particularly in safes, basically a 20% discount.
Mhm.
So these note or the safe will convert at a 20% discount. So the investor gets the benefit of converting at a lower price than the fair market value of the shares being issued in that priced around. Um, and therefore they get more shares, right? So if it's a, if it, let's say the shares, let's say it's $5 a share. Well, they get to convert if it's a 20% discount at $4 a share. So they actually get more shares. And what the discount is doing, it is compensating the investor for the risk that they have taken coming in at such an early stage, right? So, because there's always the chance that they're never going to, the company's not going to go anywhere. The company's, unfortunately, not going to make it, not going to do a round, and they're not going to get paid back. So, this is one way of compensating the investor for risk. Um, the other way to do this is a valuation cap, as Kristen was saying. Kristen, maybe do you want to talk a little bit about how the valuation cap works for both a safe or a note?
Sure. Your valuation cap is if you're not sure, right? And it's also on a fit. If you're raising, say, 1 to 3 million, which is more in the angel world or early stage, and you have a valuation cap of 50 million for your A, it's kind of a disconnect between I'm at this phase of 1 to 3, but my next phase is going to be 50. So it should parallel around where you think the next phase and the inflection point is. And in the clause, it really protects both the investor. Is this really an early stage? What's the fundraising forward that you're going to need till you get to that liquidation or next step? And then there's another side of it that it's really the lesser of whether it's the cap or the next, once you get that actual valuation, you have a balance that will protect, except for a down round, but you have the balance that will protect on where you think the valuation cap is and when you actually get to that Series A or Series seed. So there's um, a kind of evaluation range, I would say, if that makes sense to folks. And that's helpful to really, from the investor point, to let us know that from the financing point. And don't forget, folks, like this is your money, your company, you get paid last. So you want to make sure that you don't dilute yourself out of the full game and wind up watering down all of your shares to liquidation.
Right. That's actually a very good point. So, we talked about the fact that the benefit to doing the note or the safe is that you get to kick the valuation down the road and you don't need to worry about how many shares are we issuing and what, as a founding team, how much we're giving up. But
Right.
when an investor, requests there to be a cap, you do need to start. You can't. I don't know that you can actually. You can't really necessarily model it, but if it's if you agree to issue a note or a safe with a fairly low cap, you know that you are ultimately going to be giving out more of the company when you do that financing and the safe or the note convert. The safe for the note holders are going to be getting a larger chunk of the company than they would get if there was either a higher valuation cap
Good
or
point.
no valuation cap. So it's a technical point, but it's a super important point as Kristen noted. Just before we talk about the most favored nation, so there have been some questions, sort of what is an appropriate
Oh,
discount? Um, I, you know, Kristen, jump in if you. I would say the market default is sort of a 20% discount. I've seen them higher, I've seen them lower, and obviously it depends on sort of, from the investor standpoint, how much risk they believe there is in the company. If there's less risk for the investor, then they may be willing to accept a lower discount. If there's, so 10%. If it's a very risky, if they believe it's a very risky company, then they may require a 30% discount. 80%, I would say 20% generally, but I've seen them as high, as low as 10 and as high as 30. Kristen, any thoughts on
yeah.
that?
I've always seen 20. And there's two things
Okay.
here, right? Because you're also worrying about the investors don't want to dilute moving forward as well, right? So, especially when they're in the bridge range. And it's a tell of if you're going to stray from what's typical, just be ready for a lot of questions, right? So, is this savvy? Do you have an explanation why you're different? And If you are and you can explain that, great, from the financing team. But most of the investor world, I would say in the early stage, we all have 30, 40 some odd years, and we have CFOs that are part of our membership group that will calculate in their head price per share, waterfall, and the rest of us are like, wow, they do it in a split second. So, so just I would say where you really have something that you want to stick to, why it's different. Personally, I coach some of the startups that I advise. You want to look as
Kristen froze for a second there.
and cons of it
Uh,
so that you can explain.
just looking at our questions and okay, so
Just a
last
time check too. It's
yeah,
12:30.
yeah, no, yeah, we have a lot to cover, but I mean, I'm hoping that because I know actually, and Kristen, you probably see this as well, there's a lot of uncertainty at the early stage around how notes and safes work, probably more so than
Absolutely.
Series A than preferred. So I'm glad that we're covering everything and answering people's questions. Uh, Duly noted in terms of needing to move on. The one last thing, just in terms of a note of a safe, is most favored nation, and that um, comes in, and you see it occasionally, where basically a safe or a note will say these are the terms. If before they convert, so if before there's a priced round, another investor comes in with a note or a safe that has more favorable terms than we have, our note or safe get to adjust to take the benefit of those favorable terms. I don't know, Kristen, if you see these a lot. I see them very rarely, but I do see them. Um, but that's
Probably
just
not at the early stage, but if
yeah.
your
So
advice to the group is great.
um, okay, with that, if we could go on to the next slide.
Yeah.
Uh, and I'm just
Seed.
trying. Okay, so Series Seed. Um, Kristen, I mean, do you want to talk a little bit about sort of Series Seed? I know you've got some
Sure.
strong feelings about it, and just sort of you know maybe explain again what it is and when it's typically used.
Sure.
Yep.
And I would say it's really for you heard a lot about the convertible notes and safes. We, especially given the markets that have come since post-COVID, when you're in the early stage, when you're trying to raise between 1 and 3, whether it's early stage or doing a bridge in the later stages, the Series C's preferred stock, you can price around, price it at 30 cents, 50 cents, and that really offers a couple of things. It it offers a valuation, right, in a priced round, early stage with an inflection point. And then you also have some of the more formal documents, which Andy will get into, with a preferred stock and an equity raise, including some of the things he's going to talk about with pro rata, et cetera. You want your early stage investors to do the follow-on rounds. You want to keep them in your corner so they're able to, for our group, it's a little bit of our own money and a lot of our experience, right, to help you through that forming your first board or defending during a board or giving you expertise and connections. So I would say your Series C preferred stock is typically done when you can justify that valuation, right? Whether it's you've rolled out your numbers, et cetera, you and your fellow founders, your company, you're comfortable with that. And you really know what your next inflection points are, how much money you're going to need to get to a strategic and IPO, and you've done the math. And I think we see so many Series C preferred stock that this has become another norm. And I've got a portfolio that's a Series seed and then a note, and the note is supposed to go to an A, but because of the situation, they're on a seed 4. So I think it's that flex and really take advantage of reading some of these. There are, general forms and understand, ask questions to find the right tool that's going to match what you need for your financing. And then again, your seed preferred stock, there's no discount. There's none of those other things. You know what you've got. This is equity you're giving away. You know how much. You've done the math to say, I'm not just raising 3 million for some blank buckets, right? And I think especially in life science, there's a lot of non-dilutive capital. So companies can get farther along on non-dilutive, preserve their equity, and then meet some milestones to be able to do those valuations. Is that helpful?
Um, Helpful to me, certainly. Hopefully, no, no, absolutely. So I'm looking at a question here for early stage life science companies with no sales in the foreseeable future. Is Series Seed applicable? And I would say, the answer is yes. The one, I guess, the one key thing here that, as Kristen mentioned, is that when you're doing Series C preferred stock, that is a priced round, right? So
Yes.
you would, to answer the question about a very early stage R&D company, you can do Series Seed, but you'd have to have been able to develop to come to a valuation that both the company and the investors agree upon. Um, and that, that is it's difficult to do at a very early stage, but you certainly can. But, that being said, that's where the advantages of the notes and the safes come in, is that you just don't have to worry about that valuation issue. You'll wait till you're really at the point where, a valuation makes more sense. Um,
Can I add one more
yeah,
thing
yeah, yeah,
here?
please,
Yeah,
please.
because we're generalists and we have consumer products, we have enterprise SaaS. So from the life science side, I think having whether it's a 510(k), a IND submission, we're in talks with a strategic, we have a collaboration with Mayo, et cetera, there's almost stronger inflection points to be able to justify some of those valuations. And most of the biotechs that are in our portfolio, absolutely not early sales, unless you figured out a crafty way to do this. That's part of the game. And it's part of the reason you need to find that right investor that understands the space, that knows what the milestones are, that can take the risk that's appropriate, and you have the science and you have the team behind it to justify your valuation on the equity and the price that you're willing to give up. For the non-biotech, the questions are, that's great, you have sales. Are they sticky? We have nothing. There's, if there's no FDA, there's no milestone. So to us, it's kind of risky to just have crazy sales. And is that a forever or a one shot? So I think there are an ebb and flow to the biotech side of you may not have sales for a while, but you have an awful lot of science and proven history on what those milestones are to be able to hit it out of the park and achieve your goals.
Thank you, Kristen. I think the last thing on Series Seed, and I apologize, we can't get to all the questions just given the time we have, because we do want to dive into the Series A preferred. But the duly noted, and the RESI folks will take note of this, that maybe we can structure a separate webinar or something where we're only dealing with sort of the earlier stage stuff that may help to be able to answer people's questions. But I did want to, and this in part will answer one of the questions just asked. So the rights the rights of the Series C preferred can vary pretty dramatically. So I have seen them in what I call sort of what I call like a Series A light, where it's
Mhm.
basically a board seat. Yeah, as I mentioned here, a liquidation preference, typically one time, and this goes to answer the question, typically a one-time participating liquidation preference. So, that's about as company favorable as you can get, with in a board seat or even just an observer seat, no dividends, and only blocking rights on significant company events. I've also seen, and I'm sure Kristen has, Series C preferred rounds where, it's essentially a Series A round, all of the rights, bells and whistles. It's just called Series Seed versus Series A. Kristen, you're shaking your head. I mean, is that sort of consistent with what you're seeing, or have you seen them
Yeah.
trending more
And
in
again,
one direction?
to the point, it's it's changed in the small 8 years that I've been doing this, pre-COVID, et cetera. where the Series A, that just the levels are changing. And you've
Yeah.
got more players in our ecosystem. You've got micro VCs, family offices, more formal documents. So I have seen a mix. From our perspective, we're typically, a board observer. And if it's an independent board, there's a reason for it, and the team wants that. So for the amount of money, and it depends on how much more money is next, it's a back and forth discussion. And that's why it's so important to find the right smart money, the right investors that are going to help you for the long haul and to be able to set these things up, but know what rights that you're going to ask. And if you're going to get a strategic investment, if I put my M&A hat on or venture and they see like, wow, you have four angels on your board and you want our money. And now we're on a board that's a mix of, what's going on here. So you should really ask your advisors, ask for help on this so that it makes sense. And the point of early stage is that you're supported to build and scale the right way. But as Andy mentioned, knowing a lot of these rights, the big ones are pro rata because you want your early stage investors to keep and maintain their share. And you want them to invest all the way, right?
Right.
That's the point of it. The others is, some more granular details.
Mm. No, and one final point on this then, which is that as sort of Kristen had implied, as much as, safes are 5 to 7 years old. I mean, convertible notes have been around for a while, but Series C preferred stock is also a relatively new, um, financing mode. I mean, I would say maybe the last 10 years it's become a lot more common. It used to, again, used to be never saw it. It didn't exist. Then it started to exist, but only every so often. Now, I can't think of any client that's done an A round or that's considering doing an A round that doesn't now first do a Series seed round. So they become much more typical, a lot more institutional. I would also say that the rights that you're seeing are trending much more towards a close to a Series A preferred or slightly backing off the Series A preferred, but they weren't like we used to see when they first started, what I call the Series A light.
Can I
With
share one
that,
reason why?
yeah, yeah, yeah,
Like if
yeah,
I give an
please.
example of a portfolio company and just the times,
Hmm.
they might have started with a seed, four seeds later, and then a convertible note. And this is all trying to mix your non-dilutive, your funding, especially in life sciences, 7, 8 years later, if you're still trying to get to that Series A or the bridge, it's a longer time. So that might be
Absolutely.
another
And one
factor.
one last question, but this actually applies to the Series A preferred as well. Someone asked you, can you please explain the pro rata? Because Kristen had said that's
Oh,
for the really for the for the company, it's an investor right, but for the company, it is an extremely important right that for the investor to have, which basically says, in the next, let's say it's a Series seed round, the investor is investing. The pro rata right says when you do your Series A round. Um, those investors have the right to participate in that Series A round to purchase at least enough to keep their pro rata share of the company after that Series A round. Um, Investors want to have the right. The company, you want the investors to have the right because, again, as Kristen said, you want your investors to be with you along for the ride in the long term. And um, you really always, you want to, in many cases, be able to go to your existing investors first and then fill out the round with new investors. This is just the right. Almost always it's exercised. If an investor chooses not to exercise their pro rata right, then that's not a good sign because they have lost confidence in the company. Almost always it's exercised. With
almost
that
always.
could
But
be,
capital
yes.
comes and goes in our lifetime, right?
Um, yeah, absolutely. Krista, could we go on to the next
Move?
slide?
Sure.
When we next time when we do this, I'll practice a little bit more before so I don't lose the sharing. Okay, so we're going to talk somewhat fairly quickly now in the last 18 minutes here. Um, Now we're talking. We're going to jump into the uh, what I call now a more typical and traditional Series A preferred round. Uh, which I could tell you when I first started doing this back when the dinosaurs roamed, the Series A preferred round was it. I mean, there was no, you know, Very rarely did you see those. There were no safes, no Series C. Basically, the first institutional money that any company raised was a Series A round. That's all there was. Um, as Kristen said, lots more financing alternatives, earlier stage now from institutional investors, lots of different types of investors. It's made it a lot more interesting, certainly, and ultimately better for companies because they can, do things at earlier stages. Just very quickly, a lot of people hear NVCA documents. The NVCA documents, the National Venture Capital Association, is sort of just the standard set of Series A preferred documents that everybody uses. Um, you'll hear your lawyers, you'll hear the investors, you'll hear people talk about, they'll say NVCA, documents. They're good because they are well vetted. They're updated over time. So the NVCA has a committee that sort of puts these out, and uh, once or sometimes twice a year, they will update them for changes in the law, particularly if there's Delaware law changes that impact the documents. And also just, changes and trends in industry and how deals are getting done, they will update the documents. The documents are annotated, um, so whether, easier for, whether it's a company or an investor and counsel to, to sort of work through and understand them. But they're a good thing because again, everybody knows the documents. I as company counsel, for example, assuming the investors counsel is drafting, although that's not always the case. You know, if Kristen hands me a batch of MVCA docs for a Series A preferred round, yes, it's all digital, but the stack is this big. But I can work through them very, very quickly because I've looked at them dozens of times, if not more, and I know what to expect, right? So it's quick and easy, and you can do red lines of them against the form, so they're just very easy to work with. Um, some disadvantages: some people think they're overly complex. They're definitely complex. They could be simplified. That's a discussion for another day. And but everybody uses them and understands them. And some argue that because they're done by the NVCA, even though there are company lawyers, I believe, on the committee, they tend to be investor favorable. I don't necessarily agree with that because I believe that no matter who drafts and what documents you use, ultimately you'll get company counsel and investor counsel will get you to where the deal is supposed to be, regardless of whose forms you start with. But there is a little bit of this bias. But again, there's no reason not to use the MVCA document. So, Kristen, if we could go to the next slide.
Oh, sure.
Sorry about that.
No.
Okay, so Series A preferred term sheet. If anybody's looked at one, and I actually had this, the especially the NVCA Series A preferred term sheet is 15 pages long. Okay, it covers everything under the sun. We obviously don't have the time to go through 15 pages, but we're just going to talk about a couple of some of the key points in the various aspects of the term sheet itself and the document. So, an overview of the term sheet. It is non-binding, other than exclusivity and confidentiality. So you're going to go through and negotiate this term sheet, with the investors and their counsel. Um, Technically, it's not binding, okay, which means that all of the terms that you discuss and agree to can be changed, once you go into definitive documents. That's not something that you want to plan to do, and it's not something that is good to do. And typically, it doesn't work out well for the company if they come back after signing the term sheet and say, "Oh yeah, I know we agreed to this valuation and that, right? But we want to change that." That's not going to be taken well by the investors. So it also gets more complicated and more costly, and cost, takes time. So when you do negotiate the term sheet, um, assume this is going to, but for some outliers or some things that may be found in diligence, these are the terms that are also going to be agreed to. The term sheet talks about, pricing, board structure, some of the control rights. As said here, don't try to negotiate this yourself. Uh, don't rely on ChatGPT, as I know a lot of people are doing. There's, the lawyers on company counsel and investor counsel, they know this stuff. They know the stuff that ChatGPT and others don't get the nuances and don't understand. And also don't get the lawyers will understand the market trends and how things are changing, which is quickly. So you want to get your lawyers involved early on. Um, and I'm not saying that from a self-serving point of view. Kristen, if we could just go on to the next
Yeah.
slide.
I would say two things on
Oh,
this
yeah, yeah,
too,
yeah,
because if you've got a
please.
Series C, you're going to get a preferred term sheet as well. And to Andy's point on legal, having done biz dev and M&A for 15 years and thinking I know a thing or two, and then going into general counsel and having them say, all right, you write something up. It's a different language. It's really, it behooves you to have a legal advisor, a lawyer that can explain these things to you and to help you along the way because the devil's always in the detail.
Perfect. Just looking at a couple of the questions. The NVCA docs are available, nvca.org. And there's a link, you'll find a link to the model legal documents. They're easy to find. I can share those with anybody after. Again, some questions here. These are all great questions, by the way. We just don't have the time to answer them. So, all right. So the high level offering terms. We have now got 11 minutes to go through this very quickly. So these are sort of at a very high level, what is this deal all about? What is the security? We're assuming for the time being it's Series A. How long is this going to take to close? You really want to have a good sense for, are we talking about, a month? Or are we talking about 3 months? Conditions to closing, and these are fairly standard. The investors have to do their diligence. Any approvals you may have to get approvals from existing investors to do the Series A round. There may be regulatory approvals that have to happen for the company. Those are all your conditions to closing. You're listing out your investors, who they're going to be, how much they're going to be putting in, and what percent, how many shares and what percentage of the company you'll be getting. Because again, remember, this is probably the first, you're doing a price round, so you know exactly how much each investor is getting for the money that they're going to invest. Um, Pre-money valuation, and that's obviously a key thing you always need to agree on to know ultimately, how much you're going to be giving up for in that round. Moving on to the next slide. So the key components of the certificate of incorporation, the charter. Um, we talked for a second about liquidation preference, which basically says that the preferred investors are getting, when money's coming off the top, meaning when the company is sold down the line, or if the company liquidates, the preferred Series A preferred investors are getting their money back first. There's a couple different ways to structure this. Are they getting multiple, if they put in $5 million, are they getting the first 10 million back, 15 million back? Different ways to structure that. I don't think we really have the time now to drill into that, but just understand that is, one key element that your lawyer can sort of help you understand is exactly how much the preferred are taking off the top, in the case of, again, a liquidity event or a dissolution. Um,
Early stage is always one. It shouldn't be
yeah.
one.
Okay. Why don't we go
Go.
to the next slide? Um, okay. So, rights. Preferred holders typically have, a class right. So, for example, um, you know, uh, all stockholders must vote, on a sale of the company. Okay. But the preferred holders may have a class vote. So it says, you have to get a majority of the Series A preferred holders have to agree to sell the company before it even goes to a vote of all of the common. So that would be a class vote. They may have a class vote on certain blocking rights. And this also is just tied into sort of whether it's a board vote or a class vote, but they may have a right to have to approve, um, material events for the company. So, raising new capital, selling the company, doing an out license, doing an in license. These are all things that the Series A preferred as a class, as a group, are going to get to have to approve if any of these if the company is going to be able to move forward. And this is where this gives the investors the ability to control the timing of these major events as well as the value of these major events, because they could just say, no, we're not going to allow this. Um, okay, so looking at that. Um, Chris, anything you want to add here before
Oh,
we flip? Okay.
sorry, I'll go back.
No, no, that's
Well,
just
if you get into the drag along rights, I think that's a interesting one.
okay. Let's skip over the pay to play. Let's talk about redemption rights for a second, because redemption rights take a lot of verbiage in the charter, which basically says that the preferred holders have the right to basically redeem and get paid back and basically it's a put right. They can say, all right, company, we want to be paid back, and then we'll sell our shares back to the company. There's lots and lots of verbiage on this in a charter. I can tell you it's almost never actually triggered. So you do need to focus on it. But Kristen, tell me, in all my years, I think I've seen a redemption right triggered once by the investors.
Yeah, no, this is more strategic M&A if somebody's going to buy and then invest. And I don't know. I haven't
Right.
looked at it.
So
Same.
again, yeah, apologies, we're going over this so quickly. If we can go to the next slide. All right, so the purchase agreement, I mean, and all you are probably familiar with purchase agreements from your earlier rounds, and just it says who's purchase, what who the investors are, what are they purchasing, how many shares, at what price. Most importantly, what are the reps and warranties of the company? The company has to rep and warrant, that it's got no litigation filed against it. It owns all its IP to all of its, none of its employees are planning on leaving. It has no regulatory issues, things like that, because if it turns out not to be true, that gives the investors the right after the fact to basically take action against the company and say, we invested based on our understanding of the company's situation. And if it turns out that wasn't the case, the investors need some recourse. So the reps and warranties take a lot of space, but they are very important. Just again, to make sure that everybody understands what the risks are, and then if something does go wrong, who is going to ultimately, take the burden of that risk. Closing conditions, just as I mentioned, diligence. Founder revesting is actually an interesting one because, Kristen, please tell me what you've seen. A lot, and this is so for a lot of founders, you'll found the company. Let's say two founders get 50% of the company each, and they move on. So now let's just say it's your first. Let's say you've done no interim financings, and you're doing a Series A preferred round, and the investors are coming in and taking maybe a third of the company. Um, what they are most likely going to do is say, okay, you each owned 50% outright before. Now, you're each going to own, half of the two-thirds that are left, but we are going to require you to vest some of those shares as if you were coming in anew, right? So, rather than you each owning 100% of your shares outright, two founders, we're going to require you to vest some or all of those shares over time, because from an investor standpoint, we need to make sure that you are going to stick around and run this company in a way that ultimately is going to increase its value so that we as the investors can benefit. If you leave, or if you're terminated in certain situations, we can't have you walking off owning all those shares. So just like an option vests or restricted stock, you can be required to revest shares that you thought were yours 100%, and now they vest over. Now some or all of them are going to vest, and this is much, much more common. Kristen, you agree that you see it most often now?
Well, I'm glad to hear about it. Well, I see founders
Right.
investing, in later stage rounds too, given the times,
Yeah.
right? It's like we put some money in initially, we're putting more money in, we believe in this company, and that goes the same with warrants being exercised. We haven't even talked about warrants. That's another thing for everybody to look up,
Yeah.
and maybe a part two, because that has an impact when if you use warrants to be able to entice investors, it also dilutes. And, we're talking about early stage and Series A. But as you move forward, the more you can understand these terms and that financing piece, it will really benefit you um, as you build and move on to later rounds.
No, that is outstanding advice. Let's take a minute and look at just each of the rest of the documents that in the Series A preferred pack. So, Chris, if you could go on to the next. So, the investor rights agreement, um, it contains registration rights, which again, lots of verbiage, very rarely triggered in terms of the company's ability to force an IPO, or once the company already goes public, their ability to force the registration of some of the shares that they own pre-IPO. Information rights, giving, and this is very standard, giving investors, quarterly, monthly, quarterly, yearly financial statements, audited or not, and the ability to ask questions of the company. We talked about the preemptive or pro rata purchase rights. So, certain investors, usually the larger ones, will be permitted to, purchase shares in later rounds to maintain their pro rata percentage. Preferred
By the
director.
way, we go all the
Oh,
way. I have pro rata to H and F, and you want
oh yeah.
that, right?
Oh yeah, absolutely. Um, Preferred director approvals. These are you know, preferred, the Series A preferred are often going to be appointing one or two or more directors to the board. They, as board members, have certain basically blocking rights or rights to have to approve things along the lines of what we talked about before with the preferred as a class. Just some things are at the director level for way too complicated fiduciary duty reasons, well beyond the scope of this. Operating covenants, company's going to have to get D&O insurance post-closing, and just, maintain, depending what it's doing, maintain commercial insurance, et cetera. Future equity grants may be covered in the investor rights agreement, saying, all future grants of equity would be restricted stock or options are going to have a default vesting, unless the board agrees otherwise. That's what things that are covered in the investor rights agreement. Next is the right of first refusal and co-sale agreement, also known as the ROFR. Uh, Key holders, so usually the founders and some of the smaller early stage holders, if they want to sell their shares to a third party, they typically have to first offer them to the company. And then if the company doesn't want to purchase them as an entity, the preferred stockholders get a second bite at the apple. They can purchase the shares from the early stage and the founders before you're able to sell them to a third party. The co-sale right, also known as the tag-along right, says that if the preferred choose not to purchase those shares that you have offered to them because you're going to sell them to a third party, and you now are allowed to sell to a third party, they have the right to sell a pro rata portion of their shares to that same third party. Complicated, doesn't happen all that often, but it's something that is in pretty much every deal. Next is
Last slide,
go on the voting agreement. The voting agreement is what has
the way we're at
the
time.
board designation rights, right? So, how many board members they're going to be in and which investors get to designate how many directors. The voting agreement says that, this is what's allowed, and then all of the stockholders are agreeing to vote for those directors when they're designated. That's more of a technical legal point, but since the stockholders have to elect the directors, you're pre-agreeing to who the board's going to be. And then drag along rights is in the case where the board, and it may be, a majority of the preferred holders say, hey, we want to sell the company. It requires the smaller and earlier stage holders to sell their shares along with, as part of that sale. More importantly, not to challenge it, not to seek appraisal rights, to basically they're pre-agreeing to sell their shares on the same terms and not try to stop the sale or cause any trouble. That's what the drag along right is, and very important for the investors. Um, I think we are, for the
At
most
time.
part, at the end.
Yeah.
Uh, uh, yeah, so just the miscellaneous provisions. We talked about revesting. Um, And I'd say the last thing here is that there's an exclusivity provision in the term sheet that basically says, for some period of time, the company is required to, negotiate and work closely with the investors to get this thing documented. You can't talk to other potential investors during that exclusivity period. So, you need to focus on getting it done with the investors who you've signed the term sheet with. You can't go out and try to find better terms, for 30 to 45 to 60 days to give everybody a chance to try to get this done, based on that term sheet.
There's a couple of questions. Well, we're at time. But I like this
Uh,
one that said we need a series to do a deeper dive. So thank you,
yeah,
Joseph.
no,
Yeah,
I
because this
agree.
is
Yeah, I agree. There's lots of good stuff there. Unfortunately, we're out of time. For I guess a couple quick things. First, thank you, Kristen, for agreeing to do this.
absolutely.
Bringing the investor
Thank
viewpoint
you.
is unbelievably valuable. Um, you know, uh, 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 you know, for people to truly understand what's important, and more importantly, sort of just the non-legal, how these things work in the true business setting. So appreciate your having agreed to jump into this. Thank you, everybody, again for staying with us as we had to reschedule this a couple times. We will definitely talk with the Resi folks about uh, doing something maybe to answer some of these deeper dive questions. That's a great suggestion. There is a lot, there's a lot going on here, admittedly. This was our high level view. And obviously, and certainly reach out to Kristen and or, Enemy directly. You can find us through LinkedIn. If I don't know if Resi has provided our email addresses, but you can reach out to us through LinkedIn. And we're more than happy to help, answer these questions
Absolutely.
along the way. So, Kristen, any parting comment?
No, thank you. Thanks for the opportunity, Andy. And I'd love to see an exit at a Series A. Typically in life sciences, they keep going, but this is so helpful even for me to re get into the
Hmm.
weeds. These documents are lengthy. I kept saying devil's in the detail. It's not really the devil, it's
Yeah.
just understanding what you're drafting, understanding what you're signing, what you're giving up, because sometimes later in the game, if I go to the M&A point, when you're already through miles and you look back and go, why did we do those drag along brights and what investors got what? And especially with liquidation preferences, if you're running out of money and you need money and somebody comes in and it's a 4x liquidation, like it's just know your base of
No, it's a good,
documents.
and I've even worked with when I've represented investors in the past that have even come back and said a year or two later, wait, we agreed to that,
Yeah,
so it,
yeah,
these things are important. They do play out as, things ebb and flow with the company, with, doing better, not doing better, later rounds. So a lot of time is spent on getting this right, at the when everybody's agreeing on it in a closing. And a lot of these things do come into play later on for better or for worse, as the company's growing and moving forward. So thank you again, everybody. I think Kristen, one of
yeah.
us can end this.
Oh, okay. Good luck,
Um,
everyone. Hope to see you at Resi.
yes, exactly. Hope safe travels to San Francisco, everyone that's traveling, and we'll both be out there and looking forward to seeing people in person.
Okay.
Excellent. Thank you.